Hello human geographers, we are back at it again this evening. Tonight we are going to be reviewing the topic of development and exploring some of the economic indicators that allow us to evaluate it. And we start by going over that definition of development once again. The definition of development is a process of improvement in the material conditions of people through the diffusion of knowledge and technology. And earlier this year we linked the diffusion of that knowledge and technology back to the Industrial Revolution. And those countries that got it earlier were those countries that eventually became more developed. And so this definition of development allows us to divide Now, in the 1980s, this line was drawn by Willy Brandt, a German politician who was interested in development. And it divided the world into a more developed north and a less developed south. Though it should be noted that the map that's in the top left image from our textbook shows a modified Brandt line that reflects the collapse of the Soviet Union. You'll notice that several of the Central Asian former Soviet republics are south of the Brandt line, whereas in 1980, when this line was originally drawn, they were north of the Brandt line. But when we look at this same line from a polar azimuthal projection, it can reinforce another system for classifying levels of development. In this case, we have a more developed core with a less developed periphery. And then we could add another classification called the semi-periphery, which would include countries that are making strides to try and improve levels of development into a middle tier between the core and periphery. This serves us another way to classify countries' levels of development. Now tonight, we will be categorizing regions of the world using criteria related to economic structure. And using these economic indicators, the underlying assumption is that a country could raise the standard of living in certain regions by transforming their economic structure. So, economic indicators are defined as development indicators based on a country's economic production, for example, how much it produces. An example is GDP, which we'll define tonight. What kinds of things it produces, ranging from raw materials, that's the primary sector, to manufactured goods, secondary sector, and services, the tertiary sector, and how it produces them, ranging from labor intensive, meaning hard work, workers are a major part of it, subsistence production, to capital intensive, that is money intensive, specialized production. But it should be noted that economic development refers both to a process, the improvement, as well as a way of categorizing, which we will be looking at tonight, different regions of the world. So tonight, we're going to be looking at measurements of wealth that include sectoral or job structure of the labor force, income distribution, and energy use per capita, among others. But many development experts recognize that a gain in one area, such as economic growth, may have adverse consequences in another area, like the environment. So, is development really an improvement as we defined it earlier? I want you to think about that as we go through the lecture tonight. For example, we can start by looking at sectoral employment, or by that we mean the percentage of a country's workforce that is engaged in each sector of the economy. So we can start by looking at the US, which is an example of a core country, Brazil, one of our BRIC countries, a good example of the semi-periphery, and Nepal, which is part of the periphery. Now let's start with a question. Which of the shown sectors, primary, secondary, and tertiary, are good indicators of development? Notice that primary, green, and tertiary, orange, are good indicators of development. There are clear divides between each level of development in those respective areas. The secondary sector isn't as good of an indicator because you can see that that for Brazil and the United States, their percentages are basically the same. So the big question when it comes to the secondary sector is, what are they producing? What are they manufacturing? Is it labor intensive? You need a lot of low skilled workers? Or is it capital intensive? You need a lot of machines or high skilled workers. That is a better indicator than just the employment rate in that particular secondary sector. A second way that we can measure economic development is by comparing either the annual incomes of people or the total accumulated wealth of people who live in various locations. We can start by looking at gross domestic product, or GDP, which is the total value of goods and services within the borders of a country during a specific time period, usually a year. Essentially, it is the goods and services produced within a country during a given year and the value of it. All right. Now, this can be complicated by a number of problems. First, countries use different currencies. So this problem can be solved by converting all amounts to a single currency, such as the US dollar. In addition to that, the value of a currency changes over time. So this can be resolved by converting all of the amounts to that amount of money in a specific year. Then, it's also important to note that prices vary from country to country. So, for example, in 2016, the same collection of goods that cost $1,000 in the United States cost $590 in the Czech Republic, and it cost $1,620 in Switzerland. Now, this problem can be solved by converting amounts to what we call their purchasing power parity, or PPP, which is based on what an amount of money will buy. All right? And PPP is based on the idea that the price of a good or service in one country should equal the price of that same good or service in another country when it's converted to a common currency. A simple example would be that PPP would indicate that a bottle of water that is sold in Cairo and a bottle of water that's sold in Paris would cost the same amount, even though the local prices for a bottle of water might be substantially different in those respective cities. So, the GDP with purchasing power parity factored in for the United States was $20,494 billion. Then, during the same year, the GDP with purchasing power parity factored in for China was $25,361 billion, again in US dollars. All right? But another way that allows us to compare the accumulated wealth is by looking at it on a per capita basis or per person basis. Per capita comes from the Latin meaning by head. So in other words, it's an average per person. So the GDP PPP per capita in the United States was 62,000 US dollars, while the GDP PPP per capita in China was 9,000 US during that same year. Now, it is important to note that this only includes transactions that are part of the formal economy, which we'll discuss in a few minutes. And these figures give us no hint of what proportion of the population participates in the country's economy. It doesn't tell us the average citizen's material standard of living, nor does it give us gaps between genders or among regions of a country. So let's take a look at GDP per capita. And I'll ask the usual questions, and I want you to consider all these questions for all of the maps that we're going to look at tonight. What type of map are we looking at? Choropleth. What scale? National scale. And is this a good indicator of development? And the answer is generally yes, it is. And most of the things that we're going to look at tonight, really all of the things we're going to look at tonight, are good indicators of development. That's why we're including them. These are good economic indicators of a country's level of development. But often there will be outliers. And in this case, there are a few semi-periphery countries that register higher in terms of economic development. And the United Arab Emirates, or UAE, is an example of one of them. In the UAE, their subnational units are called emirates. All right? And Abu Dhabi is the emirate that dominates the banking and financial sector, as well as the petroleum industry. And that one emirate generated over half of the UAE's GDP in 2010. Dubai, which is the next largest emirate, generated about 30% of the GDP. So those two emirates alone, out of a total of 7, generated over 80% of the UAE's GDP. We don't get that information just by looking at the total. We don't look at what region it's coming from. We can change the scale, we can ask questions, but oftentimes that information isn't available in the raw data that is presented in a map like this. Another way that we can evaluate economic income is using gross national income, or GNI, which is the total value of goods and services produced per year at home or abroad by domestically owned interests within a country, formerly called gross national product. Now, to help us understand the difference, let's give an example. If a Canadian company operates a plant in India, the profits that that plant earns are counted as part of Canada's GNI. Similarly, the income earnings of Canadians living abroad are counted in the GNI for Canada. But the profits of the Canadian-owned plant operating in India would contribute to India's GDP. So that's the difference, all right, is the fact that where is that money flowing to? All right, it should be noted that GNI calculates the monetary worth of what is produced within a country plus income received from investments outside the country minus any income payments to other countries around the world. It's seen as a more accurate way of measuring a country's wealth compared to GDP, which will make more sense next chapter when we talk about the Human Development Index and their change from GDP to GNI. All right. Now, the United States doesn't have a huge difference between GNI and GDP, as you can see here. 20 trillion in GDP, 20 trillion, just slightly more, about $300 billion more in terms of GNI. But there is a country that would serve as a good example that has a very big disparity between GDP and GNI, and that country is Ireland. Ireland has a GDP of about $382 billion, but their GNI is only about $300 billion, a difference of almost $100 billion. The reason for this is because Ireland has received a lot of foreign investment, which contributes to Ireland's GDP, but because the money from those investments flows back to the country that invested it, it does not factor into Ireland's GNI. As we are looking at economic indicators throughout this lecture, we look at another example, and so we'll ask the usual questions. What type of map are we looking at? At what scale are we analyzing this? And is this a good indicator of development? And once again, just like GDP, this is a good indicator of development. In fact, it's believed to be a better indicator of development because it accounts for the flow of monetary investments across international borders. But there are limitations to GDP along with GNI in that it only measures output. In other words, it's concerned with the gross or total production rather than net. Net production would factor in the costs of it. GDP and GNI do not take into consideration the social or environmental costs that are associated with production. These non-monetary costs of production may take a toll on the environment through resource depletion and pollution of air and water. GDP and GNI per capita look at the total value added on a per person basis. But another way to evaluate a country's economic development is by looking at its poverty rates. Poverty is both an economic and a social condition because it affects income as well as other facets of well-being such as education and health. The poverty rate, or the percentage of people living in poverty, is the most common measure used to express the occurrence or incidence rate of poverty. But there are different thresholds of poverty depending on the scale, depending on, say, what country you're talking about. So for example, in the United States, the income that constitutes poverty is just under $13,000 per year on a per person basis. That amounts to $35 a day or less. Now, using the most recent data that's available to us, about 38 million Americans live in poverty, giving the United States a poverty rate of approximately 12%. But the map that we're looking at here is looking at extreme poverty. And the World Bank has established two international poverty lines that help us to distinguish between extreme poverty, what we're looking at here, that is living on $1.25 or less per day, and then moderate poverty, which is $2 per day. And so let's ask the question that we often ask: is this a good indicator of development? And we can see that once again, extreme poverty is a good indicator of development. We see the highest rates of extreme poverty in the least developed countries, and we see the lowest rates in more developed countries. Now, the formal economy is the legal economy that governments tax and monitor. So the informal economy is the uncounted or illegal economy that governments do not tax and keep track of, including everything from a garden plot in someone's backyard to the black market to the illegal drug trade. And there are a number of other names that the informal economy goes by: shadow economy, gray economy, black economy, underground economy, or just the hidden economy. And the informal economy can be seen in both rural and urban areas, but it is likely to have higher total numbers in urban areas, and it is especially a key component of survival for many people in low-income countries. Notice that Latin America, Sub-Saharan Africa, and South Asia all contribute over 30% of GDP from the informal economy. So we can see that this is once again a good indicator of development. And lots of people are involved in it. In just one country, India, 33% of their workforce works in just 3 types of informal work. Those are the ones listed: domestic workers, home-based workers, and street vendors. And that doesn't even start to get into other elements of, say, the black market, illegal drug trade, and things like that. But that's what people tend to think of with the informal economy. It can even just be people who are maids or servants, people who operate a business out of their home that isn't regulated or taxed, as well as people that set up shop on street corners and sell things. Now, later this unit, we will be discussing strategies that countries have utilized to try and improve their levels of development. One of those strategies in recent years has been about sustainable development. And this article makes an argument regarding sustainable development, or green growth as they term it, by addressing the informal economy. It's a really fascinating intersection between an indicator of a country's level of development, that is, participation rate in the formal versus informal economy, as well as strategies to try and improve those levels of development. Now, globally, one fact about income distribution remains pretty clear. There are very, very few wealthy individuals and several billion people who live in poverty. Now, there's 4 categories that sociologists and development analysts identify that impact that income distribution. Individual skills that each person may possess, social conditions that affect society at large, policies that are related to government and taxation, trade, labor forces or education, as well as historical factors that have had a significant impact on the country's economy. These historical factors could include things like slavery, colonization, warfare, or just internal unrest. All 4 of these categories can affect the income distribution, that is, the number of wealthy people versus the number of poor people within a country. Now, a metric that is used to help evaluate income inequality is the Gini coefficient. So let us start with our big question for this lecture. Is the Gini coefficient a good indicator of development? And in general, developing countries tend to have higher income inequality. And countries that are highly developed, like those in Western Europe, tend to have lower income inequality. So that's the big takeaway. Now, in another piece of evidence to support our claim that income inequality is a generally good indicator of development, our advanced economies have greater income equality. Now remember from the last slide that the closer to 0 a country registers on the Gini coefficient means greater equality. So these advanced economies have greater income equality. While emerging economies, in our classroom terms we would probably use semi-periphery countries, have greater inequality. All right. Now, the degree of income inequality in a country can have a number of serious consequences for development. First, income inequality is associated with a higher incidence rate of poverty, which we said is a good indicator of development, which in turn can deter investment in a country as well as improvements in levels of development. Second, income inequality can exacerbate tensions between the rich and poor in a country. So there might be more tension, more conflict between these groups. Third, and perhaps most importantly, when high income inequality coincides with high unemployment, countries squander valuable human resources that could be used for the betterment of the society, the economy, and trying to improve the level of development in a country. Technology is sometimes lumped into the discussion about economic indicators of development. Things like productivity per worker can be examined by adding up the production over the course of a year and dividing it by the total number of persons in the labor force. For example, the World Bank reported that agricultural productivity per worker in the United States was essentially $49,000 in 2011, while China's agricultural productivity per worker was $700 per person that same year. A more productive workforce also suggests a higher level of mechanization in production and thus higher levels of development. Now, an interesting comparison can be made by looking at cell phone subscriptions as well as internet users. Now, we notice similar patterns between the two of them. The most cell phone subscriptions and internet users appear in core countries like the Netherlands, while the lowest numbers are in the periphery, countries like Malawi. But there is a stronger correlation between wealth and internet access than between wealth and cell phone access. Let me explain. By looking at these numbers, 68% of cell phone users in the Netherlands have internet access, whereas 40% have access in Mexico, which is below the global average of 53%. And then in Malawi, it is only 23%. This suggests that instead of mobile phones equalizing internet access for rich and poor countries, the technology can either reinforce the digital divide between rich and poor. To wrap up tonight, we're going to be taking a look at environmental indicators that can indicate variations in levels of development. Things like loss of biodiversity, as well as the impacts of natural hazards. Or in other words, the likelihood of a natural hazard impacting more people and being classified as a natural disaster. Please don't misunderstand me in this particular case by thinking that natural disasters only happen in LDCs. But a country's level of development can impact the likelihood of whether or not a lot of people are impacted by a natural hazard. And then finally, we could also look at access to safe, potable water, which is what this map looks at. All of these serve as good indicators of development. Now, finally, we will leave off on perhaps one of the most important, the most prominent environmental indicators that is aligned to levels of development, and that is CO2 emissions per capita. So please make a note that this is probably one of the more important and relevant environmental indicators associated with economic development. CO2 emissions per capita are highest in the core, as well as in several countries of the semi-periphery. They are lowest amongst the global periphery. It should be noted, however, that as countries industrialize, CO2 emissions rise. So, as periphery countries become industrialized, this pattern is likely to spread to those countries as well. And that is where we will leave off for tonight. And in our next lecture, we are going to be discussing social indicators that can be used to evaluate variations in levels of development between countries. Have a good night, everyone, and we'll see you next time.